Welcome back to FX Street. It's Monday morning. It's June 14th, 2010. Welcome back, one and all. Great you for joining us. My name is Adam Rosen. I'll be your host for the next 45 minutes or so. Very special thanks to FX Street. We are going to talk today about interest rates. Now, the chart we're looking at in front of us, and please let me know if you cannot see this chart or if my sound cuts out at any time. However, as we get started, we take a look at the historical interest rate of the different central banks, the 8 major central banks that we follow. And over the past couple weeks, we've seen some really interesting turn of events. The blue line at the top represents the RBA, that's the Reserve Bank of Australia, that had been the first central bank out of the 8 currencies that we follow to raise interest rates, but they paused during the last meeting, keeping rates steady currently at 4.5%. Now, the red line, the New Zealand dollar, which represents interest rates coming out of the Reserve Bank of New Zealand, raised interest rates for the first time in a long time. It was the first change since Reserve Bank of New Zealand cut rates back down to 2.5% in April of 2009. This past month, we've seen the Reserve Bank of New Zealand raise interest rates. The light blue line is the euro, the European Central Bank, leaving rates unchanged at 1%. The orange line is the Bank of England, leaving rates unchanged at 0.5%. The green line is the Bank of Canada, which has just raised rates for the first time in a long, long time. And the first change going back again until April of 2009 when we were at a quarter point. Now we're at half a point, 0.5% interest rate. The yellow line, the white line, the Japanese yen, US dollar, no change and no change expected. However, the really big events that we've seen so far, the Kiwi to the upside, or the Reserve Bank of New Zealand to the upside, the Bank of Canada to the upside, and the Reserve Bank of Australia pausing, not changing interest rates. Well, what we're going to do is we're going to take the next 45 minutes or so and examine the central bank statements that were the result of these interest rate announcements. Now, some are a lot more significant than others. I'm going to try to follow all of them. However, as we get started here, first central bank I want to talk about is the Bank of England. Now, we should see in front of us, this is the Bank of England website. The Bank of England, this was from June 10th of this year, just a few days ago. Their statement, as they begin, says the Bank of England's Monetary Policy Committee today, that was on June 10th, voted to maintain the official bank rate paid on commercial bank reserves at 0.5%. The committee also voted to maintain the stock of asset purchases financed by the issuance of central bank reserves at £200 billion. The minutes of the meeting will be published at 9:30 a.m. on 23rd of June. So we don't have the actual minutes yet. However, another piece of news, and this is important just because, well, number one, we expect the Bank of England not to raise rates, but they're continuing with the £200 billion bond purchase program, which is fiscal policy. That's done to help the economy. However, there's something else happening in the UK which makes me very, very bullish about the British pound over the long term. This was on Bloomberg.com this morning. Britain's budget deficit will narrow more than forecast, talking about their deficit. Even as the economy grows more slowly than a previous government estimated, the UK's fiscal watchdog said in a report prepared for the June 22nd emergency budget. That's what we're talking about, the emergency budget in the next week or so. The deficit, they say, will narrow from 155 billion pounds in this fiscal year, to 71 billion pounds by April of 2015. The Office of Budget Responsibility said in London today that there's a 22 billion pound improvement on the previous forecast. Gross domestic product, GDP, will rise 2.6% next year instead of 3.25% predicted by Labour government in March. So there's a very important budget deficit meeting right around the corner, June 22nd, and basically the UK government, in coordination with the Bank of England, they're trying very, very desperately to cut the budget. Now, on the short term, this is not going to be fun because we're cutting budget, meaning we're cutting services. So less money that the government will spend. However, over the long term, it should be very conducive to a good economy in the UK, higher inflation, and that would certainly lead the Bank of England to raise rates. Because of this development, a lot of analysts have changed their opinion, including, by the way, myself, that I think the Bank of England, before this, a lot of us thought, well, the Bank of England will not raise rates until the end of the year, and some thought they will not raise rates until the beginning of next year. this has moved that pending interest rate hike to the upside up quite a bit. Now, I don't think they're going to raise rates during the next meeting. However, sooner than anticipated. The reason why all this is important, the reason why we should focus so carefully on interest rates in the different nations that we follow is because the foreign exchange market moves primarily under the anticipation of higher or lower rates. We've seen this occur very recently in the Canadian dollar, which we're going to take a look at in a moment. This is something else from Bloomberg.com, which pertains exactly to what we're talking about. Bank of England officials face interesting debates in the second half of 2010 on how long to keep up stimulus measures as the economy recovers and inflation shows resilience, policymaker Andrew Stenton said. He says, quote, surveys point to some upward pressure on public inflation expectations. Stenton wrote in an article published yesterday in the Sunday Times. He continues, there also appears to be less spare capacity in the economy than many had feared. So this certainly leads. We have two sides of the coin that we have to talk about in terms of interest rates. One is inflation and one is growth. Higher expectation of inflation, which we certainly see in the UK lately, leads the central bank, the Bank of England, to raise rates to combat that fear of inflation. The other side is growth. We read in the previous article that while growth may be a little bit down because of these budget cuts, however, over the long term, it should certainly benefit the British economy and therefore benefit the British pound to the upside. So my own personal opinion about the British pound, it's something that I thought they were going to raise rates a lot later on, the end of this year, the early next year, and it was very difficult to differentiate between the euro and the pound. I think this has now, and you'll see it on the chart. In fact, let's go to the charts really briefly. I think this really separates us from what we saw in the past in the euro pound, what we've seen recently. Here is the euro pound daily chart. Now, typically the euro pound we know is a range-bound market because the euro and the pound tend to do well and to do poorly under similar economic conditions. However, lately, in fact, since we've seen this breakdown that has occurred, well, we could say April of this past, the end of April, beginning of May, this is when all this turn of events really took place. When the euro pound broke this 8,600 level, that was a 78.6% Fibonacci retracement level, by the way. The euro pound broke to new lows. Certainly the euro has been weak. We all know that. But the pound has begun to move very, very nicely to the upside. You put a weak euro and a strong pound together, the next thing you know, you have euro pound making new lows. There's no reason to believe that this current trend cannot continue. After all, euro pound has not broken the levels we locked in since November of 2008. And the next significant support, well, let's draw Fibonacci lines. It's really, actually, we have to go to a weekly chart just to see exactly where this stands. But if we draw our Fibonacci lines all the way down from the lowest lows going back to January of 2007 up to the highest highs the euro pound saw, and that was December of 2008, January of 2009, the next thing we see, the 50% Fibonacci retracement level contains us right here on 81.75. If we break below 81.75, euro pound could certainly go lower. The 61.8% to 77.70. Now, would I trade the euro pound currency pair? Not necessarily. It's not a very fast moving currency pair. It's not easy to navigate. However, if we know, or if we have a good idea, if the euro pound breaks below this 50% Fibonacci level, we know the euro, generally speaking, is a lot weaker than the pound. So if I want to buy the dollar, or if I want to buy the yen, then I want to buy those against another currency that I think is going to be a lot weaker. In this case, that would be the euro. I'd rather short the euro dollar and not the pound dollar. Short the euro yen and not the pound yen. On the other side, if I thought the dollar and the yen were going to go down, if I thought stock markets would continue to go up, well, I'd want to sell short the dollar or the yen, those lower yielding currencies, and buy the stronger of the two between the euro and the pound. That would be the pound. So in other words, especially if the euro pound breaks below the 50% Fibonacci retracement level, my favorite trade under these circumstances would be to go short euro yen or euro dollar, and to go long pound dollar or pound yen. That obviously depends on what the stock market does, which has a relationship with the yen and the dollar. However, that's how I would frame that conversation, so to speak, as far as what we would like to go long and short. Now, really briefly, in the Eurozone, we know the European Central Bank, this was from June 10th of this year. I'm not going to read the whole statement because it's quite lengthy, but Ladies and gentlemen, we are happy to meet you, invite you to our press conference. This is the press conference of the European Central Bank leaving rates unchanged. It said, based on regular economic and monetary analysis, the Governing Council decided to leave key ECB interest rates unchanged. The current rates remain appropriate, taking into account all the information which has become available since our meeting on May the 6th. We continue to expect price developments to remain moderate over the policy relevant medium-term horizon. Okay, we know a lot of the story that's been going on in Europe in terms of the budget deficit problems all over Western Europe, and specifically the debt crisis and the government, the ratings agencies, I should say, that have cut the debt ratings on a lot of currencies, a lot of countries, including Greece, obviously, Spain, Portugal, Italy. Ireland as well. So that certainly plagues us. Now, technically, we can look at the chart and can say, well, the euro dollar is really due for a bounce. And that certainly may be true. I do not like to pick tops and bottoms, though, meaning if the euro dollar, here's a weekly chart, by the way, if the euro dollar is going down, I don't want to try to buy it under any circumstances. The trend is your friend. We're at 122.44 right now. Notice how we conveniently just paused at the 50% Fibonacci retracement level. But the fact of the matter is this downtrending resistance, which is parallel to this downtrending support, and the 61.8% Fibonacci retracement level, both of those lines, the support and Fibonacci lines, intersect right around 111.60. These are two very important lines that tell us the euro dollar could still have more room to go to the downside. Now, could we rally? Certainly. In fact, former lows of 123.27 on October 26th of last year, 2008, 2 years ago, those former lows of 123, that could be new resistance. We see the former lows of 124.50, March of 09, that could be new resistance. But the real solid resistance I feel a lot more comfortable with is near 147.75. I might want to sell short the euro dollar before we get all the way back up there. I don't know necessarily if the euro dollar is going to get all the way back up there, but I certainly do not want to buy it for fundamental reasons and technical reasons. The technical reasons are the chart is, the trend is your friend. We're going to the downside, and I'd rather, trade in the same direction as that trend. That's very simply the technical justification for not buying this. But fundamentally, we've seen currencies gain a lot of strength when there's the anticipation of higher rates sometime in the future. We've seen that with the Canadian dollar. We saw that with the Aussie dollar, which we're not seeing anymore, when we've seen that with the Kiwi dollar or the New Zealand dollar recently. One of the currencies that we've seen recent strengthen and an interest rate hike is the Bank of Canada. This is from June 1st, out of Ottawa. The Bank of Canada today, this June 1st, announced that it's raising its target for the overnight rate by 1/4 of a percentage point to 0.5%. The bank rate is correspondingly raised to 0.75%, and the deposit rate is kept at 0.25%, thus reestablishing the normal operating band of 50 basis points for the overnight rate. And here's the justification, the global economic recovery is proceeding, but is increasingly uneven across countries, I agree, with strong momentum in emerging market economies, some consolidation of the recovery in the United States, Japan, and other industrialized economies, and a possibility of renewed weakness in Europe. I agree with them on that point as well. The required rebalancing of global growth has not yet materialized, and they've hit on a very important point, which I think we're going to have to sort of reevaluate, all over again, what we believe is a good currency in terms of what central bank will raise rates first, what central bank is least likely to raise rates. In most advanced economies, we continue here, the recovery remains heavily dependent on monetary and fiscal stimulus. In general, broad forces of household, bank, and sovereign deleveraging will add to the variability and temper the pace of global growth. Recent tensions in Europe are likely to result in higher borrowing costs and more rapid tightening of fiscal policy in some countries, an important downside risk identified in the April MPC, or MPR, the Monetary Policy Report. Thus far, the spillover into Canada from events in Europe has been limited to a modest fall in commodity prices and some tightening of financial conditions. We could go on and on. I mean, they continue with a lot of other really interesting stuff. And for the essence of time, we go to the bottom. The decision still leaves considerable monetary stimulus in place. That's because interest rates are so low. Consistent with achieving the 2% inflation target in light of significant excesses in supply In Canada, the strength of domestic spending and the uneven global recovery. Given the considerable uncertainty surrounding the outlook, any further reduction in monetary stimulus would have to be weighed carefully against domestic and global economic development. They tell us the answer right there. Again, it's an uneven recovery, and they're going to be very, very careful not to raise rates too much in the future unless it's warranted by domestic and global economic development. Meaning, if Europe gets better, if oil prices really go up, and that sends, the price of oil sends the Canadian dollar higher. Canada is one of the largest producers of crude oil. And also we have inflation numbers. So in terms of Canada, it certainly is very likely that we'll see higher interest rates. It's a pretty optimistic statement, I think. But we need outside events to improve, meaning global economic events, i.e. Europe, Greece, and other nations that are really not doing so well right now. And we need domestic conditions to improve as well, or continue to improve. Number one, I would say in Canada, inflation. You want to see those inflation numbers, and they tell us right there, they tell us right here exactly what number they're looking for. They're looking for a 2% inflation target. If all of a sudden we see inflationary numbers come above the 2% target, or quickly approaching it, I think you're going to see a wide anticipation that the Bank of Canada will raise rates. That those higher rates in the Bank of Canada could certainly lead to further strength in the Canadian dollar against a lot of other currency pairs. Let's take a look at what we're looking at over here. This is the CAD Yen daily chart. Now, it seems like a pretty quiet range what we're looking at. We're at 89.34 at the moment. The uptrending support will basically right in the middle. 81.75 the support. We'll call that 8,200. Resistance up near the 9,400. So from 82 to 94, that's a 1,200 point difference. Take half of that. That's 6. 82 plus 6, 88. We're just a little bit above the exact center of the range. There's an overall upward bias to this trading range, though. We are making higher highs and higher lows. It may not look like a lot, but compare and contrast the CAD Yen to the Euro Yen. Clear trend to the downside. Currently we're improving. We're making lower lows. We're making lower highs. Euro Yen is not a very nice chart. Cable Yen, well, we're improving as well, but we're still making lower lows and lower highs. I'm picking the Yen crosses because it's an easy comparison to compare the CAD Yen to the Euro Yen, the Cable Yen. So Canada, or the Bank of Canada, or I should say the Canadian dollar, looks a lot stronger than the Euro or the Pound so far against the Japanese Yen. Aussie Yen, well, we could say there's an uptrending channel, but then again, we just broke down. In fact, our former support could very well act as new resistance right here, right around 79, 79 and a quarter. Kiwi Yen, well, there's also a rather flat trading range actually, 63.94. Seems to be making a little bit of lower highs, higher lows, or actually a little bit of lower lows. The Kiwi Yen is not incredibly encouraging, by the way, just at face value. And the Aussie Yen, well, we just broke support again. So the CAD Yen actually looks like the most healthy charts. Now, certainly there are a lot of different ways we can evaluate the charts. We could look at the RSI, the Relative Strength Index, to see which currency pair, which yen cross has the strongest RSI. We could see if we're closest to, the 20-day lows or the 20-day highs. But I think that if you go through that exercise, regardless of how you look at the yen crosses, I think more often than none, what you'll see is the CAD Yen is going to be one of the stronger of the currencies. Now, surprisingly, or maybe not surprisingly, the Bank of Canada, here's our historical interest rate, the Bank of Canada just raised rates. Now, certainly it was not a big surprise. It was actually quite widely expected. Now, the Bank of Canada just raised rates beginning of June. This is brand new. However, the strength that we've seen in the Canadian dollar has been there for a while. Remember, the market's not going to wait for us or wait for the central banks to raise rates. In fact, going back down to the lows of 82 and change on May 25th until now, which is around 3 weeks, I should say, 83 to 89, we've had a 600 pip move to the upside in the CAD Yen off of its lows. Compare that to the Euro Yen, we're 112 after hitting lows of 108. That's a 400 pip bounce off the bottom. Cable Yen, that's a lot more volatile. It's not fair to say it's even. We're at 135 off the lows of 126. We've seen some strength in the pound also lately, because of the budget deficit cuts, I believe. But nevertheless, A lot of the strength in the Canadian dollar recently is not only due to higher interest rates in Canada because of the interest rate hike, but moreover that the anticipation of higher interest rates. After all, take a look at the historical interest rates again, focusing on the dark blue line at the top. That's the Aussie, that's the Australian dollar. Now currently rates are 4.5% after coming off of lows of 3% going back to August of 09. The first hike, they raised interest rates October of 09. Yeah, October of 2009 was the first central bank, first rate hike in Australia, October of 09. Let's take a look at the Aussie yen to see where we were October of 09. Now, of course, there's other factors at work here as well. However, taking a look at the Aussie yen here, this is a daily chart Aussie yen. This is October 2009. No, it's actually, that's the end of November. Aussie yen's come down a lot. It's not a very fair comparison to look at the Aussie because the Aussie yen or the Aussie dollar, because we know when stock markets go down, the dollar and the yen go up because they're low yielding currencies. So I think the Aussie yen is down, not so much because of weakness in the Aussie lately, but moreover because of the absolute strength in the dollar and the yen due to weak stock markets. The futures are up today. That's because the dollar and the yen is weak. However, let's try to make this a little bit more of a fair comparison. Let's take a look at the Aussie Kiwi, actually. That's a very nice comparison here. Remember, October of 09 was the first time that the Reserve Bank of Australia raised rates going back quite a long time. Okay? October of 09, we were down, Aussie Kiwi was down near the 121 level. From 121, we went to April of 2010, so that's October, November, December, January, February, March, April, about 6-7 months. The Aussie Kiwi went from lows, again, near 119 up to highs of 132. That's over 1,000 pips. And Aussie and Kiwi, Australia and New Zealand, their economies are pretty similar. They benefit from the same raw material commodity sector. What's the difference in this is that the anticipation of the Reserve Bank of Australia raising rates even after the first interest rate hike was a lot greater than in New Zealand. If you recall, this whole time when the Reserve Bank of Australia was raising rates for the past year, the Reserve Bank of New Zealand said, no way, we're not doing it. Well, all of a sudden, things changed, and that's why the Aussie Kiwi went down. This downturn marks a change of perception, where the market, most of us believe, okay, Reserve Bank of Australia, they've raised rates a lot, so we're not going to raise rates anymore, but Reserve Bank of New Zealand has not raised rates yet at all, and now we're going to see, we might see a rate hike in New Zealand. That leads to selling in the Aussie and strength or buying in the Kiwi. Take a look again, historical rates. Reserve Bank of Australia raises rates the entire time. Reserve Bank of New Zealand, the red line, does not. Now Reserve Bank of Australia pauses. June of this year is a very, very important month, I think, in forex. Reserve Bank of New Zealand raises rates. I think you could continue to see the Aussie Kiwi trend to the downside. Now, again, just like the Euro Pound, I do not necessarily want to buy or sell the Aussie Kiwi currency. I think the Aussie Kiwi will continue to go down if this current trend continues. But if we have a good idea that the Aussie will continue to weaken against the Kiwi because more of us expect the Reserve Bank of New Zealand to raise rates than the Reserve Bank of Australia, I happen to be one of those, well, then if I want to sell the dollar or sell the yen, because I think stock markets will be strong, I want to buy the stronger of the two. That would indicate that I want to buy the Kiwi yen or Kiwi dollar. If I thought the dollar and the yen were going to go up, if I thought stock markets were going to go down, then I would sell the Aussie dollar or Aussie yen, trying to place the strongest against the weakest. We could do it a different way. Remember, we were talking about the euro and the pound. Remember how the Bank of England, with its budget deficit and the inflationary pressures in the UK, I think they're more likely to raise rates sooner than European Central Bank. Well, then an arbitrage or a little bit of an unusual, not unusual, but a little bit more exotic trade in the foreign exchange market would be to buy the pound, buy the stronger of the two, euro or pound. My opinion, I think pound. Sell the weaker of the two between the Aussie and the Kiwi. So that would indicate we want to buy the pound Aussie or sell short the euro the euro kiwi. Let's take a look at those currency pairs just to see if we've discovered something that has not yet been discovered. Well, take a look at this chart. Pound Aussie, very, very recently, actually going back from the middle of May until now, we've seen this perception. And this change of perception, I think, is very, very new. All of these central bank decisions that we're talking about today is June 14th, they've all occurred in the month of June. They've all occurred in the past 1 to 2 weeks. So in the past 1 to 2 weeks, we've seen a real change of events in terms of our perception of central banks and interest rates in the medium-term future. Again, what's the stronger of the two according to our analysis so far between the euro and the pound? The pound. So I'm going to buy the pound against the weaker of the two between the Aussie and the Kiwi. Buy the pound, sell the Aussie. We see pound Aussie skyrockets to the upside. Pound Aussie going back to obviously picking the lows, giving ourselves the benefit of the doubt, but down near 162, this was on May 13th. Well, we're June 14th right now. We've pulled back quite a bit, but we did hit a high to 178. That's an 1800 pip move. I do not expect to capture all of this move. However, take a look at these two candlesticks. Take a look at May 19th. The low is 165.50, 56. The high of May 20th was 177, 165. We had a 1200 pip move up in 2 trading days. The reason why I think it's important to examine the fundamental factors in the market within each central bank and how they view their own economy and therefore how they may raise or lower interest rates and how that in turn could affect the foreign exchange pairs that we trade, put our trades in the same direction of strength. If I didn't know anything about central banks and I didn't know anything about, foreign exchange or fundamental analysis, I might have seen the pound Aussie explode to the upside and say, hey, look at this. Pound Aussie is really moving up. Let me try to short this because maybe it's moving up too much. But then, factoring all this in with our fundamental knowledge, knowing that the Bank of England is probably more likely to raise rates sooner than the European Central Bank, notice that the Aussie is probably going to be a little bit weaker than the Kiwi because of Reserve Bank of Australia and New Zealand stances. This trade makes sense fundamentally only to go long. Now, put those other two currencies together. Remember the really weak euro and a really strong New Zealand dollar? The euro Kiwi? Well, take a look at this trend. We were not the first to identify this. This is a very, very long-term trend to the downside. Now, recently, we've seen a real big spike up. This was on May 20th. That was before our central bank meeting. Let's take a look at our calendar really quickly here. Taking a look at the daily FX calendar, there's a lot of great calendars out there. This is just one of them. See if there was a trade that we could have found. The European Central Bank meeting was on June 10th. The Reserve Bank of New Zealand meeting was on June 9th. So June 9th, June 10th, let's go back to the charts now. What happened after June 10th with the Euro Kiwi? June 10th, we see here Reserve Bank of New Zealand raises rates. European Central Bank leaves rates unchanged and says we're not going to do anything anytime soon. Well, since then, the Euro Kiwi's gone down. We would have made money initially. But more importantly than that, take a look at the lows of 173.64. That's on May 14th. If we break below 173, look out. Euro Kiwi, weekly chart, the next lowest lows, next plausible support is lows of 170.24 on July 22nd of 2007. But going to a monthly chart, if we break below those lows, again, we said what? 170. If we break below 170, the next lowest lows are 163. Those lows are December of 2005. The next lowest lows have to go back to 1997. The trend is your friend. The trend is the downside. Even those of us who are day traders, take a look at the monthly chart of the Euro Kiwi. If I could have told you March of 2009 that over the past, 14, 15 months, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17. And the past 17 months, if I could have gone back and taken out the crystal ball and predicted the future and said, in the next 17 months, the Euro Kiwi will only be up on a monthly basis 2 out of those 17 months. That's almost only 10%. That's probably around 12%. I'm guessing on the percentages. I'm guessing though that around 17% of the time, or I'm sorry, how should I say this? 83% of the time, the Euro Kiwi will go down over the course of the month. Well, if we're a long-term trader, and we had confidence in that prediction, that's very easy. You wait for the Euro Kiwi to rally up a little bit. You take a very, very big stop order with a very small position. You sell short and you hold on to the trade for the next 17 months. But more importantly, until the fundamentals change, there's no reason to believe that next month or this month will be the 18th month, or next month will be the 18th month. After all, I mean, if we walked into a casino and said, I want to play this game, and 17, or I should say 14 of the past 17 times that you played the game in this way, you would have made money or lost money. It's a very, very easy thing to see, to trade with the same direction as the trend. Now, again, European Central Bank, in order for this to change, let's look at our historical interest rates. In order for this fundamentally to change, we need the European Central Bank to say, hey, things are better. Greece is out of the worst of its depression, so to speak, and that things look better. The economy is better in Spain. The economy in Spain, by the way, has over 20% unemployment rate. That certainly does not conducive to a very strong economy at this point. Things are better in Italy, Ireland, all over the European, the Eurozone, so to speak. At that point, we would want to see maybe the anticipation of higher rates in the Eurozone. But imagine that happens. Remember, we're all trading, we all live together in the same world. So if things in the Eurozone really get that much better, logic would dictate that things would also get better a lot sooner in New Zealand. Remember, Reserve Bank of New Zealand, here's our statement, by the way. Reserve Bank of New Zealand raised rates already to 2.75%. And then we'll read right now that in part is due to the growth, not only in New Zealand, but global growth. We read from June 10th, the Reserve Bank today, on June 10th, increased the official cash rate, OCR, by 25 basis points to 2.75%. Reserve Bank Governor Alan Bullard said, quote, the economy has entered its second year of recovery, with growth becoming more broad-based. Don't you wish we could say that in terms of Europe? The recovery in trading partner activity is continuing, with growth in Asia particularly strong, along with ongoing growth in Australia and recovery in the U.S. This has so far offset weak growth in some other export markets. Against the backdrop, New Zealand's export commodity prices have increased sharply over the past few months, boosting export income. Export. And they export a lot of that due to the Asian countries, specifically China. So if China recovers, New Zealand does well. If New Zealand recovers, New Zealand does well. If Europe recovers, New Zealand does well. And that means that I think, until things fundamentally really change, I think that the Euro Kiwi is a very logical trade to the downside. Eventually, the euro will get oversold and we will see a bounce. And so that's why at that point, we want to use our technical analysis to try to find the best time, the best price to sell short the Euro Kiwi. Just because it's weak doesn't mean we can sell short at any point. And but fundamentally speaking, there's no reason to believe why this long-term trend cannot persist. Look at the downtrending resistance on the Euro Kiwi. We almost violated it going back up to May 21st. Did not happen though. If I want to sell short the Euro Kiwi, which I like the idea, I want to do so probably near the downtrending resistance. That's at 182.60 roughly right now, 182.50. So fundamentally, it looks like a great trade to short now. Technically, tells us to wait. We want to take those trades when fundamentally they tell us yes, it's a good idea, and technically they tell us yes, right now is a good price. Right now is a good time. So that is the New Zealand dollar in a nutshell against the euro. I like the trade though. I like the trend, I should say. What have we not talked about? Oh yeah, let's not forget Australia now. This was on June 1st. At its meeting on June 1st, the board decided to leave the cash rate unchanged at 4.5%. Since the board last met, concerns about sovereign credit worthiness in several European countries, Europe, or I should say the euro, have been a focus of financial markets, referring specifically to Greece. Investors have generally displayed a good deal more caution. As a result, equity prices have fallen. Long-term government bond rates have declined outside of the countries most affected by the sovereign concerns. The Australian dollar fell sharply as part of this adjustment. Commodity prices have also softened, though those important for Australia remain at high levels. We're talking about gold specifically. European policymakers have responded by assembling a large package to provide financing to the relevant countries for a period of time, stabilize bond markets, and provide liquidity. They have also committed to action to bring budget deficits down and stabilize debt over time. I wonder what they're talking about. We talked about this just a little while ago. This, I think, is probably the most important statement of the Reserve Bank of Australia statement. Actually, this really applies to everything. Again, European policymakers have responded by assembling a large package to provide financing for the relevant countries, talking about the European era countries, for a period of time, stabilize bond markets and provide liquidity. They have also committed to action to bring budget deficits down and stabilize debt over time. I agree with them. Why do I agree with them? Because we read right here, this is from Bloomberg.com, just a little while ago. They said Britain's budget deficit will narrow more than forecast, even as the economy grows more slowly. They're expecting the budget deficit to forecast to narrow. That's good for the UK over the long term. We also read the Bank of England. Oh yeah, remember the Bank of England release? This is from the Bank of England website. Bank of England's Monetary Policy Committee voted to maintain the official bank rate at 0.5%, but more importantly, they voted to maintain the stock asset purchases financed by the issuance of central bank reserves of £200 billion. That's their bond purchase program. So that's exactly what the Reserve Bank of Australia is saying. They're saying, we like what's going on in Europe. We think that if Europe improves, we will improve. However, for the time being, in part due to softening commodity prices, oil, not really oil so much, but other commodities have come down off their highs, and the fact that the Reserve Bank of Australia has already raised interest rates a lot, maybe it's time for a pause. They say the effects of these various factors on the world economy will need to remain under review. At this stage, global growth is expected to be at about trend pace in 2010. Conditions in Europe overall have been relatively weak, and the foreshadowed budgetary tightening will probably mean that this will continue. But growth is becoming more established in North America, and Asia growth has continued to be quite strong and may need to moderate in the year ahead. Okay, so that's Australia in a nutshell. The main difference, I think, between Reserve Bank of Australia and New Zealand is what they've done so far. I happen to agree with their decisions. Notice again, Reserve Bank of Australia was at 3% July of 2009, actually even more recently than that, September of 2009. But since then, they've raised rates from 3% to now 4.5%. From 3 to 4.5, they've raised rates by 50% more already. During that period of time, Reserve Bank of New Zealand, which also benefits from exports to Asia, exports to China, exports to the U.S., and exports to Europe, that is not helping them very much right now. But it benefits from high commodity prices and exports. Reserve Bank of Australia has raised rates from 3 to 4.5%. Reserve Bank of New Zealand had done nothing until this rate hike just this past month. So just based on that alone, Reserve Bank of Australia, I think, is probably going to pause, at least pause more than the Reserve Bank of New Zealand will. I think that we look at the central banks that have most recently raised rates, and I think that my theory is that those currencies will behave and those central banks will continue to behave in the same way that the Reserve Bank of Australia did behave, moving from 3% to 4.5%. I don't think New Zealand is going back up to 8% interest rate. But from 2.75, I think we can go to 3. I think we're at 3.5, maybe even more than that. I think from the Bank of Canada, which really was down at 0.25%, 0.25%, what happens if the Bank of Canada goes back up to 1%? All of a sudden, the CAD yen is a carry trade. The dollar CAD is a carry trade. So the central banks that have raised rates most recently, I think we could continue to see strength in those currencies, namely in the Kiwi and the CAD, as long as conditions continue to improve. Now, what happens if conditions don't improve? There are a lot of traders out there, not only traders, but a lot of analysts out there who believe the stock market, we're still due for lower lows. After all, this Gulf oil spill certainly does not bear well for the U.S. economy. We have 9.7% unemployment in the U.S. Inflationary numbers have not been good. Remember, we need inflation to pick up if we want to see higher rates in the U.S. We haven't seen inflation pick up yet in the U.S., not really. So without inflation and with unemployment still near 10%, there's not a very big chance, I think, that we're going to see the Federal Reserve to raise rates anytime soon. That creates a carry trade when we see the Bank of Canada raise rates. But what if conditions really deteriorate? What if unemployment goes to 15%? What if the stock market, or the Dow Jones Industrial Average goes back down to 7,000, 8,000? Well, then those currencies with very low interest rates that are considered to be the safe haven of capital, we buy those when we're scared, and we're talking specifically about the Japanese yen, the U.S. dollar, to a lesser extent the Swiss franc as well. We'll see those currencies really do well. We'll see the yen crosses go down. We'll see the CAD yen go down. We'll see the Aussie yen go down. We'll see, basically all the yen crosses go down to a lesser extent the dollar. But if I'm still optimistic over the long term, if I still think over the long term we will survive one day, and as a long-term trader, I want to try to find what's going to be the best next trend to the upside. I want to use that weakness to go long-term trades. After all, don't you wish we could have gone long the CAD yen when we hit these lows of 82.38 on May 25th, 8,200 basically? That was an uptrending support level just below us. From 82, we're already at 8,900. And, well, if we break out above this 9,500 highs on April of 2010, I should say, then we would be then looking at levels that we've not seen the CAD yen go back to October of 08. So I think eventually things will be better. Eventually we will see new, very strong trends go to the upside. But it's like we say in the stock market, it's a stock picker's market, so to speak. Buying the euro yen is not the same thing as buying the CAD yen. Buying the Kiwi yen is not the same as buying the Aussie yen. Central banks are the reason why currencies move, because they adjust interest rates, and our anticipation as the marketplace, our anticipation of higher, lower rates dictates how those currencies are going to trend. Now, before we go, we have a few minutes left. By the way, if there's any specific currency pairs you'd like to see, I'll be more than happy to take a look at them. We spoke about the Reserve Bank of Australia, New Zealand, UK, Eurozone, Canada. Going back to the daily effects economic calendar, what is in store for us next? Federal Reserve we haven't heard about in a while. They meet June 22nd, 23rd. That's right around the corner. I don't think the Federal Reserve will raise rates, but it'll be interesting to see what they say. June 17th, the Swiss National Bank. I don't expect a lot out of them. Bank of Japan is, well, actually, it says today. I don't know if that's accurate. The next meetings for our other central banks, July 8th, we have the European Central Bank. July 8th, we have the Bank of England. I don't expect rate hikes anytime soon there. July 20th is the Bank of Canada. They already raised rates once. Will they raise it again? July 6th is Reserve Bank of Australia. Will they pause? Reserve Bank of Australia has been on the pace lately. Raise, pause, raise, pause. We paused last time. Maybe they'll raise rates. Reserve Bank of Australia just raised rates. What will they do July 28th? The market will give us the answer. The market will tell us, and with the anticipation of higher, lower rates, where we're going to go, which central bank is most likely to move. However, use this information to our advantage, because it really positions us to take advantage of the long-term trend. And I love this chart. Closing out, just want to show you, this is a chart of the world indexes, or the world indices that are related to the 8 central banks that we follow. The dark blue line, Dow Jones Industrial Average. The DAX out of Europe is violet line. The CAC that's out of Germany is Australia. The violet line with the NZG. The TSX is Toronto Stock Exchange. SMI is from Switzerland. And the Nikkei 225 stock average index is from Japan. This teaches a very simple lesson. We are connected all over the world. Someone hurts someone else, obviously with different proportions. But if we expect the Reserve Bank of New Zealand to raise rates, if we expect the Bank of Canada to raise rates, I certainly would expect conditions in Europe to improve. I certainly would expect conditions in the UK to improve. And conversely, if conditions in the Eurozone and the UK improve, that would help their own currencies as well. Now, there are differences. The market gives us the opportunity to identify the strongest and buy that, sell short the weakest, and take advantage of it, not only the direction, the trend. You know, if we buy the Aussie yen, it goes up, fantastic. But buying the Aussie yen or buying the Kiwi yen, I should say, is a lot better of a trade, I think, than buying the Euro yen. So it's not only a question of making money and picking the right direction, but also making the best money, making the most amount of money based on the fundamental effects that, again, are caused by the decisions from our 8 central banks. With that said, I think we're just about out of time. However, if you have any questions, you can contact me directly, www.forexlaunch.com. I want to thank you all very much for joining us. Very special thanks with much, much more. Again, we thank you all very much for joining us. We wish you a great day. All profitable trades.